Welcome to tonight's Theo video for January 5th, 2016. I'm Jeff White, and so far we've seen a little bit of a shakeup to kick things off in 2016. It's kind of nice, right? I mean, volatility's kicked up, traders everywhere are starting to wonder, are we going to see it continue, or will we see volatility collapse again like it has so many other times? But you know, if anything, it's just nice to be back into the markets and getting involved. We're kind of beyond that end of year mix up of all those conditions that we discussed recently. We're kind of getting back to work, back in the routine, whatever it happens to be. If anything, maybe just after spending a little bit of quality family time over the holidays, it's good to be back to the screens. Well, tonight we're going to take a look at a few of the major averages, hopefully find some takeaways for the upcoming sessions. Today, not a whole lot of exciting action out there. Really, it was kind of a day of digestion. We saw the S&P up just 4 points. We saw the Russell up less than 2 points. We saw the Nasdaq down 11. So nothing real exciting out there. And that's to be expected. We've sold off pretty hard in the last few sessions. We've seen declines of 3 to 4% in those averages in just the previous 3 sessions coming into today. So to see kind of a pause and maybe the market kind of taking a little bit of a breather here, that's not too out of the ordinary. We're going to look a little bit closer at kind of the intermediate term picture tonight, kind of see what we can discover in each of those averages. I mean, I consider myself a market technician, essentially. It may not be exactly what you think of when you hear that phrase, though. I'm going to be on TheoTrade starting on Wednesday for the closing hour of the trading sessions going forward, and that's free right now, by the way, so be sure to share the link with your trading friends. But on there, you're going to get to know my style much more thoroughly. But essentially, you're going to find that I tend to overlook indicators in general, and that's kind of weird, to hear someone who's a technician say that. And it's not that I really view indicators as insignificant or that they're invalid, but rather I like to view the source of indicators because I think they have greater significance. And all indicators are derived from price and volume. So that's really where my focus is. I like to focus on the price action. And specifically, I look very closely at levels. I look at the presence or the absence of trends. Basically, I try to pull anything objective from the price action that I can derive from it, and maybe kind of get a little bit better feel for where things are, maybe what the general mood is. Now, you'll note that I'm not saying where we're going to go. I don't believe that charts are going to tell us where they're going to go. This is, remember, a look in the past. Even today was the past. So charts can provide some good clues for you. They can provide some, the general mood, the sentiment out there, and I think that that's definitely important. I think it's valid. It carries some value to it. But these are not going to tell us what's going to happen next. Really, the only thing that you'll ever find that's going to provide that is going to be really tomorrow's Wall Street Journal. And if you're able to get that, I want to know. So right now in the market, we're kind of seeing the mood shift a little bit. Things have turned a little bit uglier in the last couple months. We're really going back about 2 months here. Let's take a look here at the S&P 500. So the late September low, which was established right here, that was the higher low versus the August low. And since then, we saw this huge rally off this September low into right at 2 months ago. This is the beginning of November. And after that type of a advance, that was an enormous rally. It's not out of the question. It's not out of the norm to see some give back, to see some kind of a pullback, a retracement, whatever you want to call it, a breather, some profit taking. It's all the same thing. It means a short-term, relief or shift of direction. And that's normal, that's healthy price action. So we got that. And we created kind of this pullback low here into mid-November. Well, from there we rebounded in V-shaped fashion, but we were unable to eclipse that early November high. So we created this lower high. We stopped short, a la Frank Costanza. Well, then we rolled over again. But we didn't respect this mid-November low. We, in fact, went on down and broke it. We set a new low, only to recover somewhat, again, stopping short of the previous bounce high, and that created our second short-term lower high. So this would be the first lower high, this would be the second. We also undercut this first pullback low. So we've created another one here just this week on Monday. So the tide has shifted. We've kind of pulled back here, and we're sort of almost channeling to the downside here in the near term. But there are a couple of other things that are noteworthy here for the S&P. Let me zoom in here on the chart and I'll show you what I'm looking at. One is this little area right here. This was kind of the initial bounce off the August sell-off, and that stopped at the 1993, 1994 area. So that held as resistance here for a number of weeks until we finally got through it right in here, you know, early October, early to mid-October. We even came back and tested it from above. And then we were able to rebound from there again and continue that rally. So this proved to be an important zone here where this red lateral line is. We also pulled back and tested it in mid-December and held and bounced. And then we've come back, and even this week we undercut it intraday on Monday, but we were able to lift a little bit here. So for the S&P 500, this is clearly an important zone to be watching. Watch this 1993 area. If we happen to get through there, the next level to really be keeping a close eye on is going to be this unfilled gap right here for the S&P 500, which is going to be right around this area right here. That's the small unfilled gap from October 21st. That stands at, let me check my note here, that's at 1951. So if we get through 1993, keep a close eye on 1951. Just jot these numbers down or draw a line on your charts, whatever it happens to be. Keep them front and center. It's important because if we get through this level, then we may head back down to this next one. Again, it's not a matter of do we hold this level or not. The market will determine that. But if it does, then everyone's attention is going to be where's the next level to watch. And that next minor level is going to be potentially seeing this small gap get filled here from late October. Now, let's move on here. Let's take a look here at the Nasdaq. So I'm going to shift over here to the comp, and I want to zoom out just a little bit in time. I'm going to go to a 2-year daily chart because really this is kind of the section that I want to show you. In late 2014, we saw the Nasdaq find some resistance up here. That was at 48.10 and slightly beyond, just a couple points beyond it. So we'll just call that 48.10. We found that in late 2014, November and December, and spent a number of weeks beneath that level, finally pushed north of it, and then early last year in the spring we pulled back to that same area but held above it. So it was respected on both sides. We also did a little bit of respecting it late last summer, early last fall, but times were pretty volatile back then. So we're kind of approaching that same level. I want to be mindful of that. I want to keep that level on the chart in case it's respected once more. We will see. But let me zoom in a little bit further and discuss the more recent price action here in the Nasdaq. We've got a little bit of a head and shoulders pattern starting to emerge here, which is of course a higher high, and then a lower high. We've also kind of got this descending trend line here that I've drawn that really outlines the neckline of this pattern. So if we are able to get through this neckline, then obviously it opens the door for more downside. So keep a close eye on not only this neckline, which currently stands around 48.50, 48.45, kind of in that neighborhood, we'll see. But if we get through there, watch 48.10, and then beneath that is going to be a couple of unfilled gaps. We've got one right here, which is at 48.40, and that is from the close on October 21st. And then the next one beneath it is going to be right down here. That's going to be the close at 47.82 from October the 14th. So keep a close eye on these two unfilled gaps here for the Nasdaq, because if we get through this support area, those are going to be kind of targeted as well on the way down. There's more beyond that. Keep that in mind. But for now, those are kind of the intermediate term levels to be keeping a close eye on. Now, let's shift finally over to the Russell 2000. Really, I like to keep a close eye on the Russell because it is the small cap index, and small caps are where speculation is more rampant. So we get a little bit better feel for kind of the appetite for risk in the market when we look at the Russell 2000. We see how in favor or out of favor small cap stocks happen to be. So as we look here at this chart, this pink line represented the flat line last year, and you can see here that in December and the very end of November, beginning of December, we came up and threatened that flat line and kind of kissed it goodbye and just rolled over and played dead from there. Since then, we saw a little bit of a counter trend channel. We kind of created this bounce right here, and really what that created was a bit of a bear flag. So we see this kind of sell-off move here and then kind of this rebound right here, and that was confirmed with not only the break beneath this channel area on Monday, but also the creation of a new low. We undercut that low as well. And so we've kind of confirmed that bear flag pattern on a couple of fronts. And really the only thing that leaves next as potential support is this low right here set last fall at 1078.63. So keep a very close eye on that as well. Again, we're short-term extended and we kind of paused today, but again, it may just simply be a little bit of a breather before we come on down and knock on the door of support down there. So, although we've got some different looks among these averages, I mean, what is unanimous is that it's really not a pretty picture out there for the bulls at the moment. I mean, about the best thing that the bulls have in their court at the moment is that we are short-term extended to the downside. I mean, can it get more extreme? Absolutely it can. But don't be in a big hurry to jump out there in front of it. I mean, tomorrow we've got the FOMC minutes. Later this week we have plenty of big econ news. We've got, any and all of those events can certainly move the markets in a big way. But generally speaking, when the bigger picture starts to look a little bit more ugly across the board like we're starting to see, the long side in the short term is generally the cute trade. And if you've been a trader for very long, you know that the sort of pain that those cute trades can inflict. So be really careful out there trying to play for a short-term bounce. We may get it. It may be violent. But generally speaking, the technicals are starting to break down. Things are starting to, get shaken up a little bit in a negative way, and things have definitely deteriorated. I mean, maybe we're a little bit extended here and we do get that bounce, but watch in the immediate future those unfilled gaps from Monday morning on the upside. Generally, the bigger they are, the harder it is for them to fill quickly. I mean, you take a look at the Nasdaq here, we've got a pretty sizable gap here from Monday's open here to last Thursday's close on New Year's Eve. So that's generally not going to fill very quickly. It may take a little bit of time. So be very careful with that. But if this sell-off does resume, then we've got some levels to watch for with that unfilled gap at 1951 in the SPX, that 4810 area in the Nasdaq, and then of course that 52-week low in the Russell set back in late September at 1078, because those are going to be some important short-term lines in the sand. All right, if-then scenarios are important to have. Watch your levels, watch your gaps, understand the tendency of the broad market to gravitate toward those areas. Thanks a lot for stopping by TheoTrade. We'll see you in Theo Chat tomorrow. Have a great evening.